General Motors reporting fourth quarter results earlier this morning. The automaker topping profit and revenue estimates, and 2024 EPS guidance was well above street expectations. Here to help us break down the numbers, Garrett Nelson, senior analyst at CFRA. Garrett, good morning. This was a huge revenue beat in the trailing quarter. I'm not sure whether people got overzealous in terms of cutting those estimates after the company gave some guidance previously. But how does the overall picture shape up going into 2024 based on this morning's numbers?
Thanks for having me. No question, this was a very solid release from GM. They did a very good job navigating headwinds from the UAW strike last fall. Adjusted EPS came in 10 cents above consensus, mainly driven by the top line as revenue came in $3.5 billion above consensus at $43 billion. The guidance was also much better than expected. Adjusted EPS of $8.50 to $9.50 for 2024. Consensus is only at $7.76. However, if you take a closer look at the guidance, you'll see that it's mainly driven by the share repurchases that they announced in November following resolution of the UAW strike. That's $1.45 of the higher year-over-year EPS that they're expecting. So, on the surface, this looks like an incredible release, but you look a little bit closer, not quite as positive, because the higher EPS that they're expecting this year is not driven by fundamental earnings improvement.
I was wondering about that, although, the company did say it was a $10 billion accelerated repurchase plan. Was that not just fully in the estimates for per share earnings for 2024?
No, it doesn't appear that analyst estimates were updated for that. So that was the primary driver of the higher guidance.
What about trends in the underlying business? And then, of course, the company also saying that they're going to kind of move toward EV profitability or break even later this year.
We remain skeptical on the EV business. GM has been the most aggressive in investing in pure battery EVs, and a lot of those new models are coming to market in the next 12 months or so. The Chevy Blazer EV, the Silverado, the Equinox. What we found from our research is that these EVs, really most of the non-Tesla EVs, aren't selling particularly well. And so we remain skeptical of, and there's still a lot of uncertainty related to their pivot towards EVs. What consumers are saying is they want to see more hybrid models, not necessarily pure play battery EVs.
And that has been a big theme. And I guess conventional wisdom is that GM in particular is kind of caught off sides by the demand for hybrids, right? They don't necessarily have much in that way.
That's right. They've really made a big bet on the future of pure battery EVs. And so, if you take a longer term view of the story, GM has been losing market share for several years in the U.S., which is where the vast majority of their profits come from. If you look at 2023, their market share in the U.S. was about 16%, but that's down from 22% in 2008 and 28% back in 2000. So while the stocks had a big move since the November lows when it bottomed around $26, we still think that investors should stay on the sidelines here.
How hard would it be to retool to try and go after the hybrid market? I mean, that seems like a pretty big deal, but those seem to have a little more favor with consumers right now.
I think that's the big question, is how are they going to pivot from making this big bet on EVs into offering more hybrid models? We're hearing that dealerships are demanding that they produce more hybrid models because the EVs that they have out there just aren't selling particularly well. So, it's one of the big challenges that Mary Barra and her team face heading into the new year.
Yeah, I mean, you mentioned you think investors should stay on the sidelines and don't necessarily buy into the idea that they've got this sustainable earnings model at the 2024 levels, perhaps, but we are trading below 5 times the new 2024 guidance, right? I mean, I know these stocks tend to trade at very depressed multiples, but is there a chance that something goes right, even in the macro, that can make that a decent bet?
Sure, absolutely. But what we'd be looking for is more improvement in the underlying earnings of the company and not EPS growth being driven by share repurchases. So obviously that's not sustainable. They can't continue to buy back stock forever. So, until we see that, but what we've seen so far from Detroit 3 automakers and other traditional automakers is that EVs are money losers, and they're a significant drag on the overall earnings of the company. And there are very few companies who are making EVs profitably, Tesla being one of them, and that's our top pick.
Yeah, I guess the question is, can they move toward a place just because of volume growth or scale to where they can kind of outrun the losses in EVs or become a little more agnostic about what types of vehicles customers want?
Yeah, we think they're on the pathway to doing that. But again, this is not a company who's been gaining market share, and we're not optimistic on their ability to recover market share that's been lost in past years. The auto industry is just too competitive. There's too many companies, and there's too many new EV models coming to market that GM's new models are going to be competing with. So the EV market is in a state of oversaturation, and we think it's going to remain so for at least the near term.